it's clearly a very, very significant development. So remember when the BEPS program ended, it was action item 1 that did not have the consensus. So it's taken them a total of 4 to 5 years to get to this particular stage where they actually have consensus on the digital economy. Earlier, as you know, under the classic system of international taxation, uh, nexus for allowing a country to tax foreign companies' income was decided on 3 principles, which is functions, assets, and risk. Now, in the case of digital companies, this kind of falls by the wayside. The reason being is that they can operate in a country without actually triggering nexus under any of those 3 pillars. So India actually was one of the first few countries to advocate an addition of one more factor, which was market. So effectively taking far to farm, and the market being the nexus criteria, that if an enterprise operated and had a sizable market presence, then also the country should be allowed to tax such income. Now, this met with a lot of resistance. Remember, we are disturbing the classic system of taxation, which has been in vogue for almost 40 or 50 years. And there was a lot of reservations as to what would happen if you disturb that existing status quo. But with Pillar 1, that's exactly what has now happened. And we are actually looking at a situation where the basis of nexus would be determined for a company that is primarily into the digital space, based on their nexus with having either users or revenue or certain other criteria, which would get determined as more details come about in the coming few months. So by October, we should have the entire blueprint, by which time we'll actually know on what basis that nexus would be formed. But we still now have a pretty good idea that the top few digital companies that have turnover of between 10 to 20 billion euros would definitely get covered under this criteria. And what it means is also that a portion of their marginal profits would get attributed to territories such as India. And this is a huge development. So we are going against the original principles. So it's a lot of work which has gone in by many governments, and getting to this particular stage is no mean achievement. So I think India all along has advocated about the market being one of the factors, and the very fact that it's now recognized as part of Pillar 1 is testament to India's efforts. India has always taken the case that many multinationals, especially the digital multinational, simply don't pay tax. And actually this is attractive to even the countries that host some of these multinationals, because neither are they paying tax in their home jurisdictions nor in the market jurisdictions. Effectively, what it meant was investment hubs and countries that were tax havens actually gained from this particular situation. So I think what has happened is the pieces are now back in the hands of the source jurisdiction and the market jurisdiction. And I think a fairly equitable approach has come about by this division. So again, it's going to be a tough one, because typically it's going to be companies that satisfy a particular criteria. There is a basis for deciding what those companies are. Typically companies that are in the digital space and have significant market share without actually doing anything in the market jurisdictions would be the ones covered. Because remember, the ones that are existing operating in the real economy are already getting taxed. The idea being that a company that simply manufactures products in a country and then simply sells them over to another country will not get automatically covered. But the company that generates significant, what is referred to as scale without mass, that means they're able to get a sizable share of the market without actually doing anything in that territory, are the ones that are sought to be covered. So it's mainly going to be those companies whose business models are driven by the fact that they can operate from their source country and can gain significant market share by using the internet or by other digital means in order to gain that market share. So it's those companies that would get targeted. So there is a threshold that has been put into the code itself, and over there the threshold actually kind of depends on the size of the economy that is sought to be targeted. So typically there have been the economy sizes have been put into two buckets. The first bucket will trigger, so these are large economies. Again, there is a criteria for GDP. And essentially over there, 1 million euros of turnover will be the triggering point. Whereas smaller economies with a lower GDP, the triggering point will be 250,000 euros. Right. So I would say 3 or 4 things are going to happen now and between now and October, when the G20 and the overall agreement is reached. First is they need to get the remaining countries on board. So there are about 100, 200 nations who are also part of this overall initiative, who have also to be brought onto the same page. So remember, up until now, what we got on July 1 was a statement from the OECD that the G20 had reached their consensus, but that's not the consensus which is there overall for all other countries. It's likely now that there will be a lot of background politicking going on to make sure all countries that matter come on board. The second thing that will probably happen is work is going on in defining the nexus criteria, which I said as of now is still a little gray and which still needs to be fleshed out. There's also push from countries such as India to perhaps ask for a higher amount of residual profit. So currently in the first draft, they've been saying that 20 or 30% of the residual profit will be shared. But I mean, will it be 20 or will it be 30 or will it be 25? Nobody knows that. So those negotiations are still going on in the background. The third important thing is that they finally need to all tie into a legal instrument. A legal instrument by what I mean is something that will intervene or will amend the existing treaties that are there between countries around the world. So you've seen an example of this in the form of the multilateral instrument that we had. Now remember, the multilateral instrument, again, because of its complex nature, there were various opt-in, opt-out clauses. And that by itself reduces the efficiency of that document. So I'm hoping to see a much tighter multilateral document that should come out of this entire negotiation. And the fourth and the last thing that I would expect to see is that countries that have taken unilateral measures will figure out a way in which to kind of potentially roll them back, if at all. Because as you know, some countries, for instance, continue to levy unilateral measures. So there are many examples of that around the world. So clearly both cannot exist concurrently. So once the treaty gets negotiated and comes into force, which will at the earliest can be around 2023, until then, these unilateral measures will have to go through a stage of phase rollback. So how that will happen is also something which is going to happen in the next few months and years. So I don't know whether you can term it to be a sacrifice.
Okay.
Remember, what you're giving up, you're getting back in another form. Obviously, you will try to make sure that what you give up, you can get back in actually the same amounts come back. But logically, once a global consensus, remember, the equalization levy or digital services taxes are not efficient taxes. What they do is they impact business. That means they become a cost to the business, they become a cost to the consumer. Whereas a global consensus based definition of how to tax such digital companies is actually more efficient, because then companies are taxed a single amount at a single place, and then you figure out how the apportionment of those taxes need to be done. So I don't think we are at a disadvantage by stepping away from that. In fact, we will be net gainers, because there'll be a wider population of companies that will probably come into the net on an overall basis. So I would think that these revenues are bound to increase for the revenue department here in India. No, so actually that's a very good point you raise. So there was an assessment done, I think it was done last year in February or March by the OECD, where they tried to measure the impact that Pillar 1 and Pillar 2 would have, and what would it mean for tax departments around the world. So the number that they've manifested itself is in the almost into the hundreds of billions of dollars. So that means what they're seeing is that essentially income that today is sitting at some of the tax havens and some of the investment hubs will get pulled out from there and will get redistributed to the market jurisdictions and the source residence jurisdictions of some of these multinational companies. Now, an important thing that has come out of that is that the largest gains will actually be made from pillar 2 as opposed to pillar 1. So the pillar 1 problem up until now has been very small. If you see most of the large digital, at least the smaller digital companies, they're not really very profitable. They're usually making huge losses actually. It's the large digital enterprises that make up almost 80% of those profits. And by covering the top 100, they've estimated that a significant chunk of those profits and that issue will get addressed for digital. But the part which pertains to pillar 2 actually doesn't address digital. It actually goes to the route of targeting investment hubs and tax havens. There, the gains, if those can be made, are far more significant than what we will get out of pillar 1. And the OECD did do a kind of a modeling, which they did, I think, on the basis of a minimum tax. I think they used 18% as a basis. The final amount of tax has been worked out at 15%. So I'm sure there's a modeling which has been done at the OECD level. They've actually publicly disclosed that modeling as well. I am also sure India has done its own modeling, but that data is not publicly available. So it's not possible to gauge what the final benefit of that will be to India. But definitely there will be a benefit, and definitely it will be a sizable benefit. Sure. So under pillar 2, what happens is that a global minimum tax rate has been set up, and earlier it actually has a genesis in a US tax provision called the GILTI rules. Essentially, what those rules said is that if if a US company is paying certain types of income to a jurisdiction who taxes at a rate lower than 20%, then the US has the right to tax that income in the US at the difference between the US tax rate and that amount. So essentially what then happens is that this has now been adopted by the OECD countries and converted into Pillar 2. The rate of 20% has dropped to 15% based on the consensus that was reached. And essentially now what is the purpose of this is that every country in the past tried to attract big multinational investments. The reason is that the way the many small countries saw that as a way to keep their economy floating and at the high end is to attract these large corporations by giving low corporate tax. At the same time, because these large corporations would employ a whole bunch of highly paid individuals, they would gain by personal tax or by sheer volume of the transactions done through that country. They would gain, even though the rate of tax would be small, they would still gain a significant amount of corporate tax. So many of these jurisdictions would have, say, a headline tax rate of 15% or 20%, but they would have certain types of tax incentive schemes or tax holidays or a headquarter regime, which said that essentially, if you make the company in this jurisdiction a regional headquarter, we'll give you a tax rate of only 5%, even though the headline tax rate is, say, 15 or 20%. So what that did is that many multinationals ended up locating their headquarters in those jurisdictions, and they started driving income into those jurisdictions. So when you have a local headquarters, what happens is that the tendency is to try and keep more income in the jurisdiction, and that happens at the cost of either the source jurisdiction or the market jurisdiction. Now, by going in and prescribing the minimum tax, what you're trying to do is remove that incentive that is given by these investment hubs and restore the position to normality. So obviously you want it to be the highest possible and as close to the Indian tax rate as possible. Now, currently, our rate, I mean, it's we had lowered our tax rates to 15% for manufacturing, but very few companies actually pay tax at 15% because it's applied only to new manufacturing and new companies being set up. The bulk of our legacy corporate income tax is paid anywhere between 20 to 18%. That would be the range in which we are paying taxes. Now, ideally, we would want the global minimum tax to be as close to the effective tax rate in India. If the effective tax rate in India, say for instance, in this case is 20%, we would like the global minimum tax rate to also be 20%. So there's the least leakage of revenue. But this is not dictated by India alone. This is based on overall global consensus. So the US, for instance, in the GILTI rules also had 20%. But because in order to bring everybody on the same page, in order to bring the entire G20 on the same page, there was some negotiation and the agreement is 15.